Hello, everyone, and welcome to this Supply Chain Finance Community webinar sponsored by DBS. Our topic today, faster supply chain finance onboarding and why speed matters in a crisis. I'm Mike Hewitt, and I'll be moderating your session today. We've got some great speakers. I'll be introducing them in just a moment. And as always, and we're all familiar now with how webinars work, but I will need just to give you a couple of housekeeping points. First one to bear in mind, on the right-hand side of your screen, you'll see some tabs. If you can't, there's a little white arrow in a black box, small white arrow. You should see a questions tab, and you can type your questions in there, and I will ask the best of those to our participants towards the end of the webinar. You'll also see a polls tab, and we'll be asking you a couple of questions. This is genuinely interactive during our session. So our speakers today, Kristen de Groei from Windesheim University is going to be talking to us from the perspective of the smaller supplier and what the experience of onboarding is like for them. Professor Dr. David Woodger of the Technical University of Munich School of Management has been doing an ongoing survey research project into supply chain finance using data from Orbian, and is going to be sharing some of the fruits of that. And in fact, David will be joining us later in the year in another webinar to go into more detail on this. Rahul Desai is joining us from Aditya Birla. Enormous, if you're in India, you certainly know them, huge fashion and retail corporation. He'll be sharing some of the challenges and the success stories of onboarding suppliers from the perspective of a large corporate. And Divyesh Dalal from DBS Bank will be giving us the insight from the point of view of the finance provider. What does onboarding look like from their perspective? So a little bit of background before we start. What is all this about? Why are we talking right now about supplier onboarding? It's kind of the technical side of supply chain finance, not always the sexiest bit, but as you can see, it's really important. This is research from Strategic Treasurer last year, and look at that top bar there. Getting the majority of our suppliers to participate is really, really important. 51% of the respondents to this survey ranked it as the single most important factor in getting your SCF program to succeed. So even before our present global emergency, getting your suppliers onboarded was really, really important. We can also look at ICC. What's the problem when you don't get them onboarded? Well, challenges around know your customer, said ICC in their trade finance report, have slowed and even hindered the ability of banks to onboard suppliers to payable finance programs. So both from the corporate perspective and from the perspective of banks, this issue of onboarding people is absolutely crucial. And right now, during a global pandemic, loss of life, tragedies for many people, but for small businesses, it can be devastating because suddenly you're struggling to find cash to survive. And if you can be paid a little bit earlier, perhaps get some advance payment through a supplier finance scheme, that can be the difference between life and death. But if you can't join the program because onboarding is slow, inconvenient, you're going to have a real problem. So how can we fix that issue? It's a very good question, and it's one that I'm now going to ask everybody on the webinar. I did warn you all that this was going to be an interactive experience, and I'm going to tell you now that I'm going to push out this poll. There are the choices you have. You should see that poll available for you to vote on, and I'd like to see your responses to exactly this question. And I can see people beginning to answer already. So in your experience, how much is the SCF onboarding process a challenge, a barrier when you join an SCF program? And I can see we have many people from the supplier side, even more from the buying side, and a lot of people from banks and fintech. So don't be embarrassed. You can answer this poll from any side you like. We want to see a general consensus. And I can see people are still giving their responses, but already 59% are saying that it's a significant barrier to entry. I will return to that poll later on and share some of the responses with you, but even as the responses are ticking in, it's getting even more clear that it's a significant barrier to entry. Right now, over 60%, 37% saying it could be better, but it's manageable, and only 1% saying it isn't a problem. 1%. So if that's you and you said it wasn't a problem, congratulations. For the rest of us, we will move forward and find out how we might be able to make it better. So I'm going to hand over now to Christian de Huy from Windesheim University. Christian, some input from the SME perspective, I think. I'll hand over to you now.
All right, thank you very much for the introduction, Mike. Hello, everybody. My name is Christian de Huy. So I work for a Dutch university called Windesheim University, and besides that, I also do research for an Italian university called Politecnico di Milano, focused on supply chain finance on the supplier side, and more specifically on the perspective of small and medium-sized suppliers. So that is what I'm going to share with you today, our most recent research on small and medium-sized suppliers and their perspectives on supply chain finance and specifically reverse factoring. So what do we expect when we have a reverse factoring program? A buyer introduces this to a supplier, and what we would expect is usually quite straightforward. We expect a program that is financially attractive, so it has more benefits than cost for the supplier. The supplier will consider it, and you expect the supplier to accept it. So this picture is quite straightforward. However, reality is more complex, and as you can see in this picture, we collected some data. So we studied
Well, it seems we've lost Christian there. I suspect he may literally have lost his internet connection. So we're going to come back to Christian later on. Oh no, he's rejoined now. Oh, well done, Christian. Welcome back. I hope you enjoyed your small vacation from the webinar. Over to you again.
Okay, sorry, I lost connection for a second, I guess. So in the previous picture, I showed a very straightforward process of an attractive supply chain finance offer, and the supplier accepted without too much struggle, too much hassle. But reality is a bit more complex. So we collected data on 8 reverse factoring offers, and we checked the perspective of all the 3 players involved: suppliers, buyers, and banks. And we could actually see the actual contracts for most of the offers. So a lot of detailed information we could see. And based on this information, we could see whether it's financially attractive or not, whether the benefits exceeded the cost or not. And in the first 4 offers, you can see they were financially attractive. The last 4 offers, however, were financially unattractive. Why is that? Well, these were smaller buyers with a lower creditworthiness, and that is why the cost of reverse factoring were relatively high. And at the same time, the involved suppliers had quite a good creditworthiness, I would say. By the way, all of the companies I'm speaking about are from the Netherlands. The most interesting thing about this picture is the outcome. So as you can see, an offer can be financially attractive, but can still be rejected, as is the case in RFO 2 and 3. At the same time, an offer can be financially unattractive, but still be accepted, as is the case in RFO 5, 6, and 7. So it's about more than just financial attractiveness, is the main message I'm bringing today. And why is that? I will present you 4 models. And the first one shows a balanced relationship between an SME supplier and a large buyer. So there's not one party who has excessively more power than the others. There's a balanced relationship. There are more benefits than costs, so it's attractive. In this case, the SME supplier will accept it, and without too much hesitation, basically. However, in the picture below, you see that the costs are bigger than the benefits. It's a financially unattractive offer. And in that case, there is pressure from the buyer. So there's an unequal power balance, and the buyer, the SME supplier will feel like it's mandatory to say yes, because that might be his biggest customer. So in this case, pressure is the most important thing for the supplier to accept the offer. In the third case, we see a buyer who gives an offer to the supplier, which is financially attractive. So there are more benefits than cost. However, the SME supplier still rejects it. And this was the case for RFO 2 and 3. So this is very interesting. So why would the SME supplier reject an attractive offer? Usually it comes from a lack of trust towards the buyer, which is usually already there before well, before the reverse factoring offer was made, so it was already there in the relation. And what also happens, what we saw, is that the buyer presents this as something important for the SME supplier. However, the SME supplier feels like he's not getting enough information. So usually just a PowerPoint is shared with the SME supplier with very generic information, but the SME supplier has much more detailed questions, and he feels like I cannot address my questions. Okay, then we have the last one, wherein there's just a lack of knowledge on the supplier side. So the supplier doesn't know much about benefits and cost, and this could lead to the acceptance of unattractive offers also. And especially with SMEs, you will see they don't have much previous experience with supply chain finance. They don't have a lot of other buyers who offer this to them, so there is lack of knowledge. All right, so we collected the most frequently asked questions by suppliers, not necessarily the best questions, just the most frequently asked ones. And you see a lot of them have to do with the invoice approval time. So they want to know, when will the invoice be approved in the new situation? And also, can we get a guarantee about this in the contract? Because this is crucial in reverse factoring for us. So will the invoice be approved after 5 days, 10 or 15? And what guarantees do we get? Can I put the cost of doing reverse factoring for us back into the purchasing price? It's a question we actually had in 3 out of 8 cases. And what IT investments do I need to adopt reverse factoring? Then there are some what-if situations, which they is on their mind a lot. So what if the bank steps out of the contract? What happens to the payment term? Do we go back to the old situation, or do we keep the new situation with an extended payment term? And what if you, as a buyer, cannot live up to invoice approval within a certain amount of days? Which consequences for delayed approval can we put in the contract? And finally, at the end, what if we say no? Does this mean the end of the relationship? Especially suppliers, the small ones, which experience pressure, they have this question. Will saying no mean the end of the relationship? So to summarize, and this is my last slide, so what should you do? If you are a supplier, do not take a supply chain finance offer for granted. Understand what you are getting out of it and what the buyer is getting out of it. So become knowledgeable about supply chain finance before taking your decisions. But as a buyer, make sure your offer is financially attractive. However, financial attractiveness is not the only thing that's important, because trust is key. And you have to think about, how much do I want to help my supplier to understand this, to make them knowledgeable about supply chain finance. And we saw also buyers that shared calculation models with the suppliers and a bit more detailed information, which already made suppliers a lot more trustworthy. Okay, so, but also make sure that you are knowledgeable about the needs of your suppliers and about the effects of supply chain finance on your suppliers. We also saw that the buyers, some of them, they just assumed this would be profitable for their suppliers. However, they did not understand what other financing options their suppliers have and how they finance themselves before reverse factoring. So sometimes there's also lack of knowledge on the buyer side about the effects on the suppliers. Don't pressure your supplier to accept an unattractive offer is the last message. It will come back at you, and the most obvious example I have is where the suppliers put the cost of reverse factoring back into the purchasing price. And you can avoid this, I would say. This was my last slide. So
thank you. Christian, great presentation, really interesting. We already have questions flooding in. I'm afraid Jan and Tapan, I'm going to come to yours later if we have time. There's one quick one, Christian, from Sarah Hivonen, who says, what type of indicators were used to analyze the benefit versus the cost? Was the working capital impact of the supplier also part of the analysis, or only a comparison with the current financing for the supplier? So what sort of factors did you take into account?
We did a very detailed analysis, which I probably don't have the time to share right now, but yes, we did check working capital impact. We checked, for example, also the impacts on cash flow and cash flow predictability. We checked a lot of details, the impact on credit risk insurance. So not only just the effect on payment terms and the effect of costs.
Okay. So that's great advice there, based on sound data clearly. Some people have been asking whether all this is available on a recording. The answer is yes. As soon as this is finished, the recording will be available at the same place that you watch the live event. So feel free to do. Christian, thank you. We'll come back to you later, I suspect, with more questions. But it's time now to move on from specifically that SME aspect to perhaps a broader look from the perspective of supply chain finance, from the corporate side, from the provider side, as well as from the supplier side. And let's welcome David Wuttke. David, over to you.
Thank you so much, Mike, for having me here. It's a great pleasure to give here a presentation. For those who don't know me yet, I'm David. I'm with the TUM School of Management. That's the Technical University of Munich. I just took the liberty to go through the attendance list, and it was very cool to see many familiar names. So hi to everyone who knows me, and hi to everyone who doesn't know me yet. And I'm very excited to be presenting here my research. So what I'm presenting is a study that is on that has been recently published. So in case you want to learn more about it, I'm happy for questions. But there's also a research paper out in the Journal of Operations Management where we provide all the technical details, and there are many of them that I'm kind of skipping here today. The study is called An Empirical Analysis of Supply Chain Finance Adoption. It's together with Yves Rosenzweig, who's professor at Emory, and together with Zeb Heath, who's professor at NC State University. Now, this work has also been in collaboration in a certain sense together with Orbian. That's a long-term collaboration that we have been going on. It started actually in 2013, and as Mike pointed out, in September, likely there will be another webinar on this platform here where we talk more about other insights that we gain. And the collaboration is set up in a way that I obtain anonymized data from Orbian, which is already a pretty comprehensive data set that I can use for econometric analysis. And one of the highest objectives, or the main objectives that we have, is not to study what people say they would do or what suppliers argue this could be a reason, but really pin it down onto what are actual decisions and analyze them, which also means it's kind of a bit of a challenge econometrically speaking. How do you get to what people really decided and given the data. Now, when I'm talking about supply chain finance, I think I don't need to explain it here in much detail. We all know it. When I talk about supply chain finance, some call it supplier finance, some call it reverse factoring. What I really mean is that a buyer confirms an invoice to a third party, and that third party then may immediately trigger the payment to the supplier, and the buyer covers the loan principal, if you will, after some extended payment terms. So in fact, we all also know not only what it is, but also the benefits. It's a win-win-win situation. I heard this a lot. Actually, 7 years ago, I heard already win-win-win situation everywhere. Supplier is better off, gets money at attractive rates. Buyer is better off by just paying later without any additional cost. And supply chain finance providers have a very small transaction fee, but tipping into large revenues, they tend to be better off as well. So it's a win-win-win situation. Everyone is happy. Everyone should be happy. Everyone should be using it. We should be only seeing supply chain finance everywhere. But even long before Corona, it was, and I think Mike did a great job in motivating it with a more recent study. There were executives complaining and saying, this is not what we see. It's not that everyone is using it. And the poll showed it earlier today. And here's a quote by McKinsey, who also found one of the most important problems is getting suppliers on board quickly. And this is not only because it's technically difficult, but there's more to it, right? It's not just something that you can do easily. So the question is, why is it that some suppliers lag behind in adopting? Specifically, what we did in our research is that we asked two research questions, namely, what are the key drivers of supplier adoption speed, and how can we identify fast suppliers or adopters? Now, we want to know this because for buyers, it's really important. And I suppose that, and maybe, it's up to you, right? But the buyers in this webinar, maybe you agree that identifying those suppliers where you're likely more successful to getting them on board quickly, this can be a pro, particularly when you're in the beginning phase of supply chain finance implementation. Now, when looking into the theory related to supply chain finance, we see that supply chain finance is pretty new, but other technological innovations on a company level have been adopted so far. When we look into the literature, we see there are two sets of drivers. One is what we call the efficiency motive drivers. you adopt a new innovation, a new technology faster if you are expecting larger benefits, larger economic benefits, like cost impact, cost benefit impact. If this is more, then you're likely to adopt faster. On the other hand, there is something, and that is something we should not forget, that's called the legitimacy motive drivers. Now, when I'm adopting an innovation, it's not only about the money that I save, but also whether I feel this is a good innovation, that's something I should do. Specifically, what about my competitors? Are they using it? Would I be the exception? Do I have to follow? Is there some pressure? So there's the economic perspective and the legitimacy perspective that we are combining in our research. We want to explore then, how does that affect the supplier adoption speed? And supplier adoption speed is here defined basically as the time when a supplier got exposed to the idea of using supply chain finance with a buyer in the buyer's program, until the time when really the first transaction is taking place. Now, let me break it a bit more down into our conceptual model. We got 5 hypotheses that we are testing, 2 of which are related to the efficiency motive drivers, 3 of which are related to legitimacy motive drivers. Now, with efficiency motive drivers, we had as a first hypothesis that suppliers that lack access to financing, which here specifically we operationalize through their supplier size, because we all know SMEs are not always, or do not always, face a more difficult access to finance, but they tend to have more difficult access to finance. So with those with lacking access to finance, adopt faster. This is what we hypothesize first. And then we look into the estimated cost reduction, where we take some proxy for the supplier's cost of capital, see what the payment terms have been before, what is the offer on the table, what will be the payment terms with supply chain finance, what will be the discount rate, and what is the expected cost reduction here. And we argue that if you expect larger cost reductions, then as a supplier, you would put more effort in this project and thus adopt faster. Looking at legitimacy, what is it that literature has identified? First of all, there's mimetic pressures. Mimetic pressures arise when my competitors are using supply chain finance, and I feel I would be perceived as a laggard, and I have to follow suit because they are using it. Specifically, what we did in our data set, we looked into each industry, and at the specific time at which one focal supplier would be informed about supply chain finance, we looked how many other suppliers in that industry are already using it as a proxy to see, is it something, at webinars you always learn everyone in your industry is doing it, you should follow suit, or would you say, well, other industries, yes, but maybe mine is not suitable here. Normative pressures arise when a buyer is already running a program with many suppliers on it. If I'm the first supplier, I feel like I'm the oddball, right? I'm the guinea pig. Should I really do so? This is not the norm. That is something exceptional. However, if the buyer can tell there is a lot of suppliers that are already onboarded, maybe 100, 200 suppliers plus, then I feel like, okay, this is a standard practice, and I should also adopt quickly because this is the way business is done. That's the norm. And finally, coercive pressures, that is operationalized here as the portion of a supplier's revenue accounted for by that buyer. So if I only have 0.5% of my revenue from that buyer, well, I could say no. But if I have 50% of my revenue with that buyer, I might be more inclined to say yes if there's an offer on the table. I might be inclined to do so quickly. We got tons of control variables, which you need in an econometric study like this one. So far, this is what we hypothesize, right? Based on theory, based on what has been happening on the past, we think this is a reasonable, expectation, those 5 hypotheses, and they can be argued for. Now, the key is testing this empirically, econometrically with real data. And here's what we find. We find actually hypotheses 1 through 4 to be supported. That is, the chance that we see a pattern here and that this is just by random, this is very low. It's below 5%. So this is supported, which means we can say that hypothesis 1 to 4, this is actually what is consistent with the data. Hypothesis 5, interestingly though, is not supported, which means that it seems that coercive pressures are not at force. To be very precise, what does it mean? If you're a buyer and you think your supplier is highly dependent on you, that is not enough. That does not mean that the supplier will follow suit, at least not in our data set. It also gives some indications that adopting supply chain finance in such a program is not about it's not about a power story. It's not about I enforce it on my suppliers. It's really about, the suppliers wanting also to improve something, and it's not used as a really strict enforcement tool here. Okay, that's basically what I would say from the theoretical perspective. There's a lot of details that we could discuss also, and I'm happy for any technical question later on. Now, what is it that we can learn from it when we look into the managerial implications? And I think that's very important. That's also one of the key challenges in research, right? Not only make a theoretical contribution, but have something meaningful out of it. Now, I grouped it into basically 3 blocks of buyers, suppliers, and supply chain finance. Provide us, what is it that you could learn? First of all, from a buyer's perspective, you can achieve faster adoption according to our study. Financing cost reductions are effective, so make an attractive offer to suppliers and they're more likely to adopt quicker. Smaller suppliers adopt faster, that's what we see in the data. So it might be a good idea, if you think about whom should I approach first, go for those that have more benefits. Smaller suppliers, get them on board. That of course requires you to have a program which is so efficient that you can onboard even small suppliers. Get them on board, then use the mimetic pressure. So target those industries where there are already many suppliers using it, and you will expect a higher adoption rate. Don't go for any of the common pitfalls. So don't underestimate the time it takes to get suppliers on board. It's not just sending out an offer and they reply, thank you so much, we are on. It is really more of a long-term project. Don't go straight for your largest suppliers. They might have good financing solutions already, but build up mimetic and normative pressure by getting the smaller ones on board, and then showcase what you can do with it and get the larger ones on board. From a supplier's perspective, I think based on this data and the more than 1,000 supplier buyer diets that we analyzed here, which means this is full data. There are many more in the data set, but with full data, about 1,400 diets that we analyzed in this paper, it shows that supply chain finance is being used. It shows that substantial payment terms are real and that we can see them in real data. So it's not unusual. Still, suppliers benefit from it. So I believe that this is adding at least partially to creating legitimacy. Finally, and I noticed there are some supply chain finance providers here and banks. So here's one question to you all: when you go to a customer or client and you want to convince them of this is how supply chain finance works, let me look at your buyers and let me structure them, your supplier portfolio. Do you just look into what is their size, what is the potential, how much could you save in terms of DPOs, what could be the impact? Or would you also look into how likely and how quickly do I think those suppliers would get on board, so that you can have a targeted strategy, like go for those ones first and those ones later. So I think that including the timing dimension in any supplier portfolio analysis approach is really important. That's what our research shows. Again, I kept out all the technical details. There's a long technical appendix. I'm happy to take any questions as long as time permits. And with that, thank you so much for listening, and I'm handing over back to Mike.
Thanks, David. And yeah, you're right. We're going to leap through some of those technical slides, which are there for later perusal, if you'd like to. In a moment, I'm going to move on to Rahul Desai for the perspective of a large corporate. But first, David, just one quick question, and an interesting one from Chantal Juice, who asks, do you think that the culture of a supplier country might also play a role in how likely a supplier is to accept onboarding? Was that something you looked at or not?
This is an excellent question, and we did look into it, because it turns out that Eve Rosenzweig, who's on the project, she's expert in in supply chain strategy and also in cultural background of firms. So we did look a lot in it. We did not find any significant differences. So we used what's called the Herfindahl index. No, it was not the Herfindahl. It was we used different cultural dimensions along which we measured. Hofstadter's index we used in order to capture culture and cultural proximity between buyers and suppliers. But it seems that at least here we did not find any significant effect of culture according to Hofstadter's dimensions.
Great. Thank you for that. And I can see a couple of people asking, is it possible to get access to the full study? I understand it's published, so what we'll do is send a link out to everyone that's registered on the webinar immediately afterwards. So you'll get a post-event email, and we'll include a link so you can get access to the full study. David, for now, thank you very much. We've got heaps of questions coming in, so I'm sure there'll be more for you later on. But as I mentioned, it's time now to move on. We've heard the research perspective, but what really matters, of course, if you are a large corporate, what's your experience of going through this onboarding program? And we have with us today Rahul Desai, as I mentioned, Aditya Birla Group, very large retail and fashion conglomerate in India. So Rahul, thank you very much for joining us. It's great to have you here.
Thanks, Mike, for your introduction. So just a bit about the Aditya Birla Group. It's one of the largest groups in India with a worldwide footprint, and the worldwide turnover of the group is around 50 billion plus. In India, we are one of the largest apparel retail players in the country, having both brands as well as retail formats across value chain, across premium segments, across super premium segments. And we also retail a lot of international brands in India. So we have a very varied and different supply chain compared to. So we have large corporates who supply material to us. I mean, fabric and stuff like that. Then we have very, very small garmenters spread across the length and breadth of the country. We also import a lot from suppliers in countries like Bangladesh, again, where there are pretty scattered. And we have large international brands from whom we buy finished product also. So we have a very, very large and varied supply chain. And I'd like to just dwell upon the onboarding as a very crucial aspect of supply chain financing. I mean, as the topic says, why does speed matter, and what is it that we've achieved? So we have been working with DBS in India over the last couple of months. We launched this new supplier financing scheme with DBS, and I'd just like to take you through some of the things that were novel and very, very unique in this onboarding process, and how it has helped both us as a large corporate, and how it has helped our suppliers also, who are some of whom are very, very small, marginal and medium players, as Christian said, who are quite vulnerable to disruptions like COVID. Actually, COVID has disrupted not just the smaller players, but even the larger suppliers, the fabric suppliers, the denim suppliers, because banks have taken a very, very, on a credit scale, they've taken a very, very harsh view on what this industry may or may not go through. So I'll just take you through some of the perspectives. So when we started off this program in the month, it was a full-blown COVID shutdown, and that India had one of the most severe shutdowns in anywhere in the world. And we started working with the DBS team, Vishram and others to roll out this program. The program details we all worked out, online, just like we are doing on this webinar. We got into calls and we rolled it out. The ease of the program lies in the fact that they just needed the same information that we already had on our database. So our SAP database already has captured our some of the suppliers' credentials. So their dates of incorporation and their GST numbers and the PAN numbers and stuff like that. DBS used the same thing to onboard onto that system, and in the back end they had some agencies which corroborated these facts, and they were able to onboard suppliers in maximum 2 or 3 days. I mean, this is something unbelievable even for suppliers who went for vendor financing or who are approaching banks for any sort of post shipment finance. And this level of speed I mean, in India, which is a very highly regulated country with a lot of RBI, I mean, the Reserve Bank of India, which is our central bank's, I mean, they view all transactions and onboarding with a magnifying glass. But DBS was able to, with its, with its partners, able to onboard these suppliers in record time, sometimes 2 days, 3 days. And the second part of the whole thing is, as far as the structure of the whole transaction is concerned, it was structured as an early payment mechanism. So we signed a very simple agreement with DBS saying that you will make early payment to our suppliers on bills which are accepted by us. So DBS, DBS had to just we used to give them, the DBS had a 2-page agreement which the supplier had to just fill up, saying that, this is the bill outstanding, this is the rate of interest, and this is, and this is the tenor of the credit. So, please pay us early. So they would get the payment. So from the date of when we submitted the details to the bank, between 4 to 7 days, every supplier was made this early payment. So the supplier was extremely happy. The rate of interest or the cost of the financing was very competitive. I mean, it was so it was very easy to convince the suppliers that this program is for your benefits, it's for the ease of benefit. It was a fully transparent program. Legitimacy of a program is very key, as previous speakers also have said. And we were able to convince our suppliers, and we got, I mean, we have more than 600 suppliers, almost 500 are already on board with DBS in this program. And we've been able to give them the financing, as soon as they sign that 2-page agreement. The 2-page agreement also has zero legalese. It is just an agreement with the name of the company, their bank account, the rate of interest, and and the tenor of the of the credit, and that's it. And they get paid, and they're out. The program is very easy. It's very easy for our buyers to understand it, because our buyers go and discuss this with the suppliers, and the suppliers and the buyer. It is so easy for the buyers to also understand. I mean, all of them who are not people who are trained in finance or in any of that thing, they're all able to understand it. Suppliers who are not very sophisticated can understand this very easily. And the program became in a short period of time, a big success. So this was appreciated by all within the company, the CEOs, the CFOs of the different divisions. All of them have appreciated this program and made full use of it. So this has been one of the great achievements. Third thing is, this program is extremely cost efficient. In fact, it doesn't even take much time for anybody to fill out the form or to explain, to the suppliers that how this is beneficial to you. And it saves, because the ultimate credit lies on us. It is a very cost efficient program throughout the chain. So it helps businesses to be able to push for that extra bit of gross margin which the supplier financing can give. Had the supplier, who are small and medium enterprises, gone to the market to a bank or to a finance company to borrow, they would have borrowed at 1.5 times or maybe 2 times the cost that which. So it has helped overall in cost efficiency also in our system. So not only does it give early payments, but it also is very cost effective for the suppliers. This third thing that I would like to highlight in the DBS program is that this program has also in certain cases helped us to lengthen the payable time. So for example, if a supplier was to get paid say within 2 months, within 60 days, because the cost of this program is less, the supplier has agreed to give us a longer credit period, and that helps us to lengthen our payables time in the program also. The fourth very important thing for treasurers and CFOs to understand is that this program, which is an early payment program, is neither a borrowing for the supplier So it is not a borrowing in the books of the supplier, neither is it a borrowing in the books of the company, the corporate who is who's running the program, because we have just signed an early payment agreement. So it is neither, because the interest is borne by the supplier. So there is nothing that makes it a borrowing in our books, neither is it a borrowing in the books of the supplier. It's one of the great it's one of the biggest advantages of the program that that this program is. Finally, the ease of documentation I've already spoken about. I mean, the supplier has to fill out a one-page form. I mean, I've never seen something so simple and so easy to implement. One is the speed of onboarding, and second is the speed of implementation. This program from DBS is addresses both these issues. In fact, from the time that we give them our SAP dump for the supplier, we in most cases we've been able to disburse the payment within 7 days. As I said, this program works both for our domestic suppliers in India also, and it works for international suppliers in foreign currency also. So it's pretty much a universal program and not just related to our domestic country. And finally, the team. I mean, the team is excellent. They've turned around documentations and everything within times unheard of in the banking systems in India. So I think overall the DBS vendor financing or supplier financing scheme is one of the best that is available in the country at this moment. So I think it, taking into account all these aspects, I think it has helped a lot of our suppliers, mitigate the problems that would have occurred because of COVID, because of banks and finance companies, just freezing their credit lines and all that, which has happened in India. So this program has really benefited a whole host of suppliers, both small, and let me say again, it has also helped large suppliers to get their payments. Otherwise, because normally, as earlier speakers have already spoken, even large suppliers in a COVID situation, those in the apparel and textile business have seen credit lines being frozen or relooked at by banks. But this program has helped them to shore up revenues and get their payments in time, early actually, not in time, I mean much earlier than normal, and has helped them to tide over a crisis. I mean, it's that's where I want to leave it. If there are any questions in terms of other finer aspects, I can always answer.
Rahul, we have literally thousands of questions, but I'm not going to put them all to you. We don't have time. Some of them are quite technical, and they involve the bank as well. And we have Divyesh from DBS coming in a moment, so perhaps we could put those a little bit later. But two questions that I think would be interesting to ask right now. The first one is, when a supplier signs the early payment agreement, are they taking early payment on every invoice, or can they select as they go forward which invoices they want early payment on?
Yes, so they can select which invoice they want early payment on. There's absolutely no compulsion to go for early payment on all invoices. But the cost that DBS has given for this program, I don't think anybody is going to have a quarrel with the cost. A large supplier or small supplier, yeah. Absolutely.
And I guess the second question, which we can ask sort of immediately, is roughly, I mean, you mentioned a very quick onboarding time, but from the moment that you decided, okay, we need to put some kind of early payment program in place, to actually getting the first supplier onboarded, how quick was that program to get the SAP integration in place, to go through the procedure with DBS before that first supplier came on board?
Yes, so all that DBS needs is, so we run a SAP program and we capture all the details we have a lot of details of all the suppliers. The same details we just gave to, we just took that SAP dump and gave it to DBS. DBS has some agencies in the background who did a quick KYC on them and onboarded them. So the onboarding process is extremely efficient and extremely fast.
Rahul,
So,
thanks for that. As I mentioned, we've got so many questions, but
yes,
we're
yes.
going to move on now. So we'll
Sure.
come back to you later if that's okay with some more questions.
Absolutely,
But
absolutely.
really, really interesting to get that insight into what is a very large corporate and how quick the process seems to have been. Devesh Dalal, we have lots of questions about process, so some of these may well be answered in your presentation. So if I can hand over to you, give us a bank perspective on how you see this really fast digital onboarding that you've managed to get through here.
Yeah, thanks a lot. So thanks David, Christian, as well as Rahul. I think you guys have set the tone perfectly well. And as we've seen, I think most of us have probably faced challenges around supply chain financing across the board. Some of it is also, I think most of the studies that have been done in pre-COVID. So actually, if you add on the layering of complexities arising of COVID, I think it just magnifies significantly. And I think that's what Rahul was alluding to in terms of what the market is at today, where are the challenges that suppliers face, and even in terms of just going and getting or identifying if an answer in the market is a significant challenge. So what I'll do is I'll just kind of briefly take you through a couple of slides which kind of touch upon what are the challenges in the traditional model. I mean, some of those have been touched upon earlier, but I thought a brief would really help out here. First is, I think typically a supplier finance program, when you kind of run, these are largely run by anchors, and therefore anchors run into challenges with respect to having a unit at their end which interacts with suppliers, identifies what's kind of going right, wrong, engaging with these suppliers, and then handing it back to the bank. So I think the whole coordination is significantly heavy. Second is there is a significant dependency on the anchors team, right? So again, out here, like Rahul mentioned, the Aditya Birla team has to be really involved deeply with the suppliers, and there is no contact with the bank. So again, there is a to and fro out there at their end with respect to which suppliers to kind of go ahead and engage. And again, the documents get routed through the anchor again, which again seems to be a challenge with eats into the days, and therefore those couple of days or 2 or 3 days actually lands up being a week or more. This was also kind of seen in the study that Christian mentioned, but again, I would like to allude that that if you add the layer of COVID onto it, the time just kind of increases significantly. The physical document flow obviously kind of is a bigger challenge, and therefore what we've kind of been able to achieve in 3 to 2 days, I think is now probably at 5 to 7 days on the traditional model side. So all in all, it's largely anchor driven, a lot of paper involved. There's a lot of back and forth. Banks do not get involved in terms of interacting with suppliers, and the TAT obviously goes for a toss in a very large way. Now, if you move from there to what the digital onboarding kind of results in is, one is the fact that our platform is completely digitized in the sense that today, for example, like Rahul alluded to, we obtain all the information with respect to suppliers directly from the anchor. So the anchor has information in their SAP or the ERPs today, and we take that information and we have the ability to go ahead and onboard close to more than 100 suppliers instantly, i.e. If the information is available in the format and the form that's required, it would be a straight-through process. Again, that can be done by the anchor itself. There is no intervention from the bank end, and it could be done on the bank's platform. This could be done through APIs, or it can be also done through the online banking platform that the bank provides. First is that. Second is a significantly shortened KYC. Most of the information, again, that was alluded to by Rahul earlier, we try to use APIs to identify whether GST number, etc., are correct. So I think that's what we do in a very large way. The other piece is visibility with respect to the supplier onboarding. So clearly, the platform also provides information with respect to if you've given 100 suppliers or 200 suppliers, those 100 or 200 suppliers, which ones are onboarded and which ones are not, and the reasons for not being onboarded. Again, if you compare this to what the traditional model would have been, there would be documentation which would come back and forth, and then you would kind of get back to the anchor for cases where the documentation is incomplete, right? So again, the visibility on an online real-time basis just gives you the ability to get back to the supplier quickly. And again, the supplier has access to this portal also. So the supplier itself can actually identify once they've signed up the extent to which the invoices have been received in finance. And lastly, again, it gives you visibility with respect to end-to-end financing as well as customization. So I think all in all, one is you onboard through the front-end platform that you have. You can also use APIs to onboard. The KYC information which is obtained by by the bank from the anchor. That is, again, we are validated digitally. We don't need to go around obtaining information from the supplier. Even the supplier confirmation letter, which is what Rahul alluded to as the agreement, even that is obtained digitally. So even that information can be, or consent can be obtained digitally on the DBS platform. And last but not the least, you have visibility with respect to which suppliers are onboarded and not onboarded. So if you compare this to the traditional platform or even existing platforms in the market, it's significantly different. And given the fact that, it is up and running, it provides anchors like, like Rahul mentioned, the ability to scale up quickly. We probably in less than a month's time went from 0 to having close to 500 suppliers on the platform, which I think is significant. If you take a traditional platform, this will take more than 6 months to get on board. So I think the scalability as well as the ability to reach out to far more number of suppliers, especially in times like this, is just amazing. And you could see that in a platform which is more digital than being more paper or physical driven. Again, the piece that I would like to kind of allude out here is what helps us to kind of achieve such shorter tides and customer wow as well as supplier wows is it's more plug and play with Anchor's ERP and all the ERPs we are kind of hooked onto today. It's the details can be provided through APIs. The onboarding also is not, which again, onboarding plus even the supplier confirmation can be obtained or digitally on the platform. The supplier details as well as notifications back to suppliers can be given through reverse API feed. So if customers are technologically up there in terms of providing information, we can take. Lastly, again, the transaction initiation, which Rahul mentioned, takes a couple of days, 2 to 3 days. We can reduce that further also if you have the ability to provide API-based information from a perspective of of an anchor. So, all in all, I think the platform provides you to onboard a supplier in a very short time frame. One can use the bank platform or APIs to push information. The confirmation as well as the supplier KYC is validated digitally. It's not a physical model wherein you obtain information and then you validate by reviewing the documents at the back end. So that's quicker. The supplier confirmations as well as the transaction related confirmation can be provided through APIs. And last but not the least, your financing requests as well as repayment statuses, etc., can also be kind of given through APIs. So again, we believe it's a platform that's probably was the need of the hour in the past, but again, COVID has just kind of accelerated the acceptance. And like Aditya Birla, we're seeing a lot of customers accepting this platform, and we see that this will probably be the benchmark going forward across markets, where suppliers are really looking at a solution which is far more nimbler than the old model. Last but not the least, I'd like to mention out here is the information that comes through APIs with respect to suppliers that also provides us the ability to provide purchase order financing. So although Rahul touched upon the post shipment and everyone out here on the webinar has talked of post shipment, the ability to get information digitally also helps us identify at a supplier level which suppliers are actually getting invoices approved quickly, and basis that we provide even purchase order financing to a particular set of suppliers. So again, it gives you the ability to get deeper into the supply chain and also helps the anchor actually provide support to the supplier, especially in such times. So again, I think it's a brilliant solution. And with the purchase order sitting on the back of it, it just nails most of the requests that customers have. And again, from what Christian had mentioned earlier, I think it addresses most of the queries or the requirements that suppliers have put forward. So with that, I'm done with my presentation. Happy to take questions from from the audience.
Excellent, and we do have a great many questions. It's a really, really interesting system. Many of the questions are very technical. Some of them you'll already be seeing if you've asked a question are being answered directly by our guests and speakers. So you may well get a written reply.
Sure.
But some that aren't. First of all, a more general question about the DBS platform. The use of APIs clearly speeds things up. Is this something you effectively have to create afresh for each new client that wants to put a program in place, or is it effectively a solution you've built that can be applied pretty much straight away to any new client that wants to put an early payment or SCF program in place? So is it bespoke, or is it kind of built once and can be applied many times?
No, so it's not bespoke. It's a plug and play, as I mentioned in my slide. It's plug and play across ERPs, and for APIs, obviously we've got to kind of integrate with customers who want information through APIs. But otherwise, it's not a bespoke that was done for Aditya Birla. In fact, if it was bespoke, we wouldn't have been able to do it in a month. We've been able to get 500 suppliers onboarded and financing done in a month's time, which is just staggering in terms of just the time and the speed in which at which we've kind of been able to execute.
Okay, and then Tapan Agarwal says, and one for Divyesh and for Rahul, do you see any market for dynamic discounting? I mean, this sounds like a pretty sort of straightforward early payment. You know, there's an agreed early payment period. But is there a dynamic discounting element, or could that be part of it?
Yeah, it could be part of it. So it depends how. So all these programs, rather most of the programs are anchor-led in our case, and therefore, as you know, as Rahul mentioned earlier, we would be guided by what what the anchor would desire. So if the anchor wishes that that there is dynamic discounting that they would want to kind of bring in, it's fine. But otherwise, we'd kind of be guided by them. The platform does provide the ability to do it. Short answer.
Yes, but we haven't gone in for a dynamic discounting program because it becomes, very difficult to administer, and then, to explain to buyers that, offer one one level of discounting to one supplier and another to another supplier. We wanted to keep it easy, and quickly implementable. So we just went with one rate to everybody, and it's been a tremendous success. I mean, we can do,
Correct. So sorry. So I just like to mention what Rahul said is right. I think in COVID times, you just want to get the liquidity out there to the supplier, and you don't want, challenges with respect to rates, etc., because then that negotiation just takes forever. So I think that's one thing which really we've seen most customers kind of getting in. And as he had mentioned, right, if they went out to get credit in the market today, they would have struggled to kind of get credit given the times they are. But with strong anchors like Aditya Birla, they are able to actually get liquidity far more in the supply chain. And as I said, we can actually work at a good point in time. You can get into purchase order, which also helps the supplier again. So I think dynamic discounting, yes, ability is there, but is that the need of the hour right now is the question you have to ask yourself.
Yes, okay. And then you should also, the program should also carry legitimacy, because within the buyers there should be no heartburn in terms of some suppliers being given a lesser discount, some being given a larger discount. It actually, when you try to implement it in the ground, on the ground within the divisions, it becomes very messy. Yeah. So I'd rather not do dynamic discounting at that stage.
Okay, all makes absolute sense. I can see that, sadly, we literally have 2 minutes left. There are a lot of questions, but as you'll see, a lot of them have written answers, and you can review the recording afterwards to take a look and remind yourself of anything covered in the recording. For now, it really falls for me to thank our speakers. What an amazing session this has been. It's all been great. If you're able, come back online for a moment and say hello. We can all wave goodbye simultaneously to the hundreds of people around the world who are with us today. If you enjoyed this, thank the supply chain finance community. Interestingly, one question that came up was about training and what's possible. The supply chain finance community has a wide range of resources that can help you with that, so don't be afraid to get in touch. And next webinar, specifically on new ways to finance SMEs, again sponsored by DBS, Thursday, July the 16th. And if you go to that rather complex URL at the bottom there, sadly I can't provide you with a direct link at the moment, but you can find it fairly easily if you go to that URL, app.livestorm.co/adagio-media. So from me, thank you to everyone. Thank you to all of you for attending. Thank you for the thousands of questions. And congratulations to Rahul and to DBS for what sounds like a really excellent program delivered in record time. And we look forward, of course, to revisiting David and getting a bigger insight into that research program at a forthcoming webinar. For now, thank you again. We'll see you all again soon, and be safe. Thank you.
Thank you very much. Have a good day. Bye-bye.
Bye, everyone.